Okay, so let me tell you about one of the strangest calls I've ever gotten. This was about a year ago. I get a call from a CEO. We'll call her Sarah. And she says, Gary, we're profitable, but we're dying. And I'm thinking, what does that even mean? So I ask her to explain. She says, we've been in business for 20 years. Our gross margins are actually above industry average. We're doing good revenue, over $20 million a year. But at the end of every year, when we look at our net profit, it's nothing, 3%. 3%. And for context, in her industry, she's in manufacturing, making industrial components. A healthy net profit margin should be somewhere between 8 and 12%. So yeah, 3%, that's not sustainable. So I asked the obvious question, where's the money going? And she says, that's what I need you to help me figure out, because honestly, Gary, I have no idea. Now, if you're a CFO or CEO listening to this and you're thinking, wait, how do you not know where your money is going? Let me tell you, this is way more common than you think. Because here's the thing, when you're growing, when revenue is coming in, when you're hitting your targets, it's really easy to ignore the fact that your expenses are growing faster than your revenue. You hire a person here, you add a service there, you approve a new software subscription, you say yes to a consultant, and none of it feels that big individually. But over time, it adds up. And suddenly you're working harder than ever, making more money than ever, and keeping less of it. That was Sarah's situation. And when I dug in, what I found was, honestly, it was worse than I expected. All right, so we start the discovery process. And I'm going through their P&L, their payroll, their vendor lists, and pretty quickly a pattern emerges. Problem number one, payroll was way too high relative to revenue. They had about 120 employees, and on paper that doesn't sound crazy for a $20 million manufacturing company. But here's the kicker. They had 3 HR coordinators. 3 for 120 people. They had 2 full-time IT people, plus they were paying for managed IT services. So they were basically paying for IT twice. They had administrative assistants in every department. Finance had 2 admins, operations had an admin, sales had an admin, even the warehouse manager had an admin. And I'm looking at this thinking, who's assisting the assistants? Problem number 2, no expense approval process whatsoever. Department heads could just spend. They'd buy software, hire contractors, approve vendor invoices, and as long as it was in the budget, nobody questioned it. Except here's the thing. The budgets were padded, like significantly padded. Because every year, department heads would ask for more than they needed, knowing they might get cut. And then when they didn't get cut, they'd spend it anyway. Because use it or lose it, right? So you had this culture where nobody was incentivized to save money. In fact, if you didn't spend your full budget, you were worried you'd get less next year. And problem number 3, this was the big one. There was massive duplication across departments. Every department had their own systems, their own vendors, their own way of doing things. Finance was using one accounting platform, operations was using a different ERP, sales had their own CRM, and nobody was talking to each other. So you'd have situations where, I kid you not, 2 different departments were paying for the same software subscription because nobody thought to check. And when I brought all of this to Sarah, she just kind of sat there, quiet, for like a full minute. And then she says, I knew it was bad. I didn't realize it was this bad. Now here's the thing. Sarah's not a bad CEO. She'd built this company from nothing. She knew her product. She knew her customers. But like a lot of founders, she was so focused on growth, on sales, on production, on getting orders out the door, that she let the back office run on autopilot. And when you do that, when you let expenses run on autopilot, they run up, always. And if you're listening to this right now and you're thinking, I wonder if we have the same problem, ask yourself these questions. Do you have more than one person doing the same job across different departments? Can your department heads spend money without multi-level approval? Are you paying for software or services that multiple teams are using independently? If the answer to any of those is yes, you've got profit leaks. Okay, so let's talk about what we did. All right, so here's how we approached this. Phase 1, we implemented an expense approval system. And I know that sounds boring, but stay with me. This was critical. Up until this point, department heads could approve any expense under $5,000 on their own. Anything over $5,000 went to the CFO. Anything over $20,000 went to Sarah. But here's the problem with that. Most expenses are under $5,000. So 90% of spending was happening with zero oversight. So we changed the rules. New rule. Any new recurring expense, doesn't matter if it's $50 a month or $5,000 a month, has to be approved by finance and the CFO. One-time expenses under $1,000? Fine, department heads can approve. Everything else needs a second set of eyes. And listen, people hated this at first. I had one department head tell me, "You're slowing us down, you're killing agility." And I said, no, what's killing you is spending $75,000 a year on software you don't need. Which, by the way, was true. They were paying for a project management tool that literally 3 people used. But okay, the expense approval system was step 1. That gave us visibility. Now we needed to actually reduce costs. Phase 2, the departmental audit. And this is where things got uncomfortable. We went department by department and asked 3 questions. 1, what does this department actually do? Not what they're supposed to do. What do they actually do on a day-to-day basis? 2, what's the output? Like, if this department didn't exist, what would break? And 3, where's the redundancy? Are they doing work that someone else is also doing? And man, the answers were eye-opening. We found that one of the HR coordinators spent 80% of her time scheduling interviews. That's it, just scheduling. Which, by the way, could have been automated with a $30 a month scheduling tool. We found that the 2 IT people were basically doing help desk support. My computer won't turn on, I forgot my password. Stuff that the managed IT service was also supposed to be handling. So we were paying twice for the same thing. And here's the one that really got me. Every department had an admin. And I asked, what do the admins do? And the answers were all versions of, they schedule meetings, they file paperwork, they manage calendars. So I said, okay, what if we had one admin who supported all the department heads? What if we created a shared services model? And that's when Sarah looked at me and said, Gary, are you telling me we need to fire people? And I said, no, I'm telling you we need to redeploy people. Because right now you have smart, capable people doing tasks that don't move the needle. What if we could put those people in roles where they actually add value? And that's exactly what we did. Phase 3, consolidation and shared services. We took the 3 HR coordinators and turned them into 1 HR manager and 1 recruiter. The third person, we moved her into operations where they actually needed help with process documentation. We consolidated the admins into a 2-person shared services team. Instead of every department having their admin, we created a pool. Need a meeting scheduled? You submit a request. Need paperwork filed? Submit a request. Same level of service, half the headcount. We eliminated one of the IT roles and renegotiated the managed services contract. Saved $60,000 a year right there. And we created a vendor consolidation project. We went through every software subscription, every service contract, every vendor relationship and asked, do we actually need this? And in a lot of cases, the answer was no. Now, here's where it almost fell apart. About halfway through the implementation, the operations VP came to Sarah and said, this is a mistake. You're going to lose good people. Morale is tanking. People think you're cutting costs so you can sell the company. And Sarah called me freaked out. She's like, Gary, is this worth it? Are we destroying the culture? And I had to be really honest with her. I said, Sarah, here's the truth. Some people are going to be unhappy. Some people like the old way because it was comfortable. they had job security, they didn't have to prove their value. But here's what's also true. If you don't fix this, you're not going to have a company to have a culture in. Because at 3% net profit, one bad year, one economic downturn, one lost customer, and you're done. And she got it. She steadied herself, she communicated the vision to the team, she was transparent about why we were making these changes. And you know what? Most people got on board. The ones who didn't, they left. And honestly, that was okay. Because the people who stayed were the ones who wanted to be part of building something sustainable. All right, let's talk results. So 6 months after we started this project, here's where we landed. Net profit margin, 3% to 8% in 6 months. That's over $1 million in additional net profit on the same revenue. Annual operational cost savings, over $500,000. We cut payroll by about $200,000 a year through the shared services model and role consolidation. We cut software and vendor spend by another $150,000. We reduced administrative overhead, things like office supplies, travel, discretionary spending by about $150,000. Staff hours saved, 250 hours per month. That's 3,000 hours a year. And here's the beautiful part. Those hours didn't just disappear. They got redeployed into higher value work. The finance team started doing actual financial analysis instead of just data entry. The operations team started focusing on process improvement instead of firefighting. And Sarah, man, the transformation in Sarah was incredible. She told me, Gary, for the first time in 5 years, I can actually see where my money is going. I can make decisions based on data instead of gut feel. And I'm not terrified every time I look at the bank account. But here's the result I'm most proud of. They maintained healthy sales growth through all of this. Because that was the fear, right? If we cut costs, we're going to lose our ability to grow. But that's not what happened. They actually grew revenue by about 10% that year. Because they weren't distracted by inefficiency anymore. They could focus on what actually mattered: serving customers, improving products, winning new business. Quality over quantity. That was the whole strategy. And the financial health? Night and day. Improved liquidity, stabilized cash flow. And when they went to their bank to renew their credit line, the bank increased their limit. Because now the numbers actually made sense. Now, if you're listening to this and you're thinking, okay, but my situation is different, let me tell you, it's probably not as different as you think. This pattern shows up everywhere. Doesn't matter if you're in manufacturing, distribution, services, software. Doesn't matter if you're $10 million or $50 million in revenue. If your net profit margin is below where it should be and you're not sure why, it's almost always the same things: payroll bloat, uncontrolled spending, and duplication. All right, let's talk about lessons. Okay, so what did I learn from this engagement? 3 big things. Lesson 1, the symptom is rarely the problem. Sarah thought the problem was we're not pricing our products high enough. That wasn't it. The problem was we're spending money on things that don't generate value. And I see this all the time. CEOs and CFOs looking at revenue as the solution to every problem. If we just grow top line, the bottom line will fix itself. No, it won't. If you're inefficient at $20 million, you'll be inefficient at $30 million. You'll just be losing more money. Lesson 2. Everyone is sacred is a profit killer. There's this tendency, especially in smaller companies, to treat every employee like they're irreplaceable. We can't let anyone go. They've been with us for years. They're family. And I get it, I really do. But here's the hard truth. If someone's role doesn't add measurable value, you're not helping them by keeping them in that role. You're actually doing them and the company a disservice. The goal isn't to fire people. The goal is to make sure every person is in a role where they can contribute meaningfully. And sometimes that means restructuring. It means consolidating. It means having uncomfortable conversations. Lesson 3. Shared services is the unlock. Most mid-market companies operate like a collection of mini companies. Every department does their own thing. They have their own budgets, their own vendors, their own processes. And that works when you're small. But once you get to a certain size, that model becomes incredibly expensive. Shared services, where you centralize admin, IT, HR, procurement, that's where you unlock massive savings. Because suddenly you're not paying for the same thing 5 times. You're paying for it once and everyone benefits. All right, so if you're a CEO or CFO listening to this and you're seeing yourself in Sarah's story, here's what I want you to do. Step 1, look at your net profit margin. Compare it to industry benchmarks. If you're significantly below where you should be, you have a cost problem. Step 2, do a payroll analysis. What percentage of revenue is going to payroll? For most businesses, it should be between 20 and 40%. If you're over 40%, you have payroll bloat. Step 3, audit your recurring expenses. Software, vendors, contracts. If you can't explain why you're paying for something, you probably shouldn't be. And look, this stuff is hard. It's politically hard, it's emotionally hard. It's way easier to just keep doing what you've been doing. But if you want to build a company that's sustainable, that's profitable, that can weather tough times, you have to be willing to make hard calls. And if you need help with that, that's literally what we do at Ledger Labs. We help CFOs and CEOs figure out where the money is going, cut what doesn't matter, and invest in what does. You can find us at theledgerlabs.com, book a consultation, let's talk through your numbers, and let's figure out how to get you from 3% to 8%, or whatever your version of that is. All right, that's it for this case study. Thanks for listening. I'll catch you on the next one.